Good afternoon. This is Dwayne Lowry for the DPP Grain Desk with Sunday afternoon comments on Sunday, February 26th. First of all, as far as tonight is concerned, I think outside markets are going to have a lot of influence on how we trade here tonight, and I find the direction for outside markets here to be rather uncertain. Um, I think it's possible that we could experience some buyer remorse in the crude oil market after $2 gains on Friday as traders prepare for the weekend, etc. And we walk in and we find out there's nothing new in terms of Iranian developments, and Israeli Prime Minister is going to visit the U.S. and speak with President Obama on March 5th. So the idea that there's an imminent new uh, direct confrontation there is probably not likely, and I think the that could be enough to create some buyer remorse here in crude to start the week out. Also, you got Saudi Arabia confirming through their weekly exports of crude that they have clearly ramped up production significantly and have the potential to increase production that more than completely offsets all of Iran's crude oil exports. So the real threat to crude oil prices is not really supply; it's actually the ability to ship supply from the region. And unless there is a new development from on Iran's stance, and we create direct military confrontations, or they decided they were going to do something to put mines in the strait, which basically we would view as military operations. Unless we get to something like that, I don't think you have a supply disruption in crude at all, as Saudi Arabia totally commits to increase in their export rate. So I think that from a price standpoint, the crude oil from a technical perspective is overdone, extended, very vulnerable to some sort of a setback, and the potential to set crude back $4 or $5 would be, really nothing considering the advances they've had here over the last couple of weeks. So I think that market is set up for some vulnerability. The dollar index should stabilize at current levels, and I think we're poised to see the dollar strengthen in the months ahead, probably for the next couple of years. That's the type of trend that I expect to unfold in the dollar, not a declining U.S. dollar, as has been a popular opinion by just about everyone. I do not think that's what we're dealing with, and I think that we may see stabilizing and recovery efforts begin in the dollar here over the next week or two. The gold market is going to be a reflection of the dollar rate ideas and a reflection of inflation. I don't think that's a real issue, and I think the gold technical conditions are vulnerable to a setback as well. So when I throw in all of the outside markets and what kind of tone might be expected there, I think there's a decent chance that could weigh on commodity sentiment here this week, and but that'll be something to watch for tonight. As far as the grains are concerned for tonight, I think a steady call is a legitimate way to start out here. Weather really isn't that important. Trades moving away from concerns about South American weather. They're starting to shift focus to U.S. weather, and of course this is really too early to be having any day-to-day influence, but it is something on traders' radar screens. They're trying to figure out, if the Midwest is going to see some improvement in soil moisture, especially in the northwestern part of the Midwest. Short-term forecasts might offer a little bit more improved prospects for that, but I don't think weather here is a day-to-day, minute-to-minute type influence on the grain trade. Technical conditions in the grain trade are vulnerable. If you get beans to trade 5, 6, 7 cents lower, it doesn't take much more weakness than that to begin to trigger some sell stop activity and liquidation. Fundamental information for the grain trade, I think, can be best summarized by what we saw from USDA last week at their annual Outlook conference. There was basically nothing bullish in any of it. The wheat data was clearly bearish. The wheat price relationship to corn has been for several months, and looks like it's going to continue to be at a very cheap price value relative to corn, which is going to maximize wheat usage at the expense of corn. And that pattern has been existing for several months, and it looks like it's going to continue. That's going to be a heavy anchor on corn price potential to the upside. Corn carryout figures from USDA for the new crop is set under anything semblance of normal production to basically double carryout levels for the next marketing year at 800 million. The old crop carryout, it might be fair to say it's tight, but keep in mind that the market doesn't have to do anything to achieve that 800 million. It's not like we have to cut back and ration demand 200 or 300 million bushels just to maintain that 800 million. That's not the case. Ethanol industry still has problems. How much that translates to lowered usage is a very debatable topic here, but there are definitely signs that they're beginning to slow production. Um, so I don't think there's anything fundamentally here supportive, and I don't think there will be anything fundamentally supportive until or unless you can get a spring or summer weather storyline to develop. I think it's also important to point out that if between now and the U.S. planting season in 2012, through that completion period, if we maintain some semblance of a normal spring season or an early season, which at the present time, the lack of snow cover makes it very realistic to project a normal or even an earlier than normal U.S. planting season. If that is the case, I think that's going to weigh on price trends. Farmers holding a very large amount of old crop corn inventory here, and while they are in no hurry to make sales and they financially are in no pressure to make sales, the calendar is working against them, and I think that's something that needs to be mentioned. As far as soybeans are concerned, I don't think you have anything bullish fundamentally here, but you do have a situation that as we look ahead to the next growing season, the soybeans are going to have to increase acreage. Whether that increase comes in the U.S. or South America or a combination remains to be seen. That might mean that soybeans have to improve their price relationship to corn, but here again, that doesn't necessarily mean it is done by bean prices going up. It's very possible it's done by corn prices going down, and I think that as we look ahead over the next 12 to 18 months, producers have plenty of reasons to be concerned about a profitability attack on their production operation, and I think that they still need to take a defensive approach to price protection. Even though new crop corn is currently not a very attractive price, I'll give you that, and it's at the bottom end of parameters for the last year of what you could have made new crop 2012 sales. But at the same token, you're dealing with prices at 558, 560 for DS12 futures that could easily have downside risk of $5 or lower, and I think those are the type of levels that are possible to be achieved at the end of the U.S. planting season if we're off to a good start. These are not downside price risks only for harvest time in October or September. These are downside price risks that could unfold in the next few months if we have favorable conditions. There's just an awful lot of price pressure here, and we do not have the same type of fundamental base and foundation of support and nervousness that we've had many of the last several years. And I think we also have the global investor looking at other places other than commodities for ownership. The combination here makes for a delicate situation and one that is definitely remains a threat for U.S. producers. So I still don't see any merit in maintaining old crop inventories of corn or beans, but certainly not corn. You got a large premium already over new crop, and you certainly have the capabilities of seeing price pressure unfold here during the next few months. So as far as tonight is concerned, I'm just going to go with steady. I'm not sure what we're going to see with outside market trends, but I think they're vulnerable to trend turning reversals here at any moment. I think that could put some pressure on commodities. I think there's a lack of a bullish storyline in wheat or corn, and any bullishness in beans is largely a bigger macro picture that is concerned about price relationships to increase soybean acreage in the next marketing year, but that can easily come to South America. It does not have to do anything to entice acreage here for 2012 in the U.S. So let's go with steady, but I think that we need to be very concerned about some price vulnerability in the very near term here. The DPP grain desk has been Dwayne Lowry.